What's up YouTube, Dougie Chong here. Welcome to today's episode where I'll be talking about portfolio diversification. I'll start off with saying that most people should just buy an index fund like the S&P 500. It outperforms most people, and even my portfolio does about the same in terms of total returns. That isn't to say that you can't pick a few stocks that are going to beat the market or even beat the market for a few years, but it is very hard to beat the markets for a long-term horizon, something like 15 or more years. When I first started investing, like most people, my portfolio started small. It was maybe only $5,000 to $10,000. It was with TD, so it charged about $10 of commission at the time, which is quite a lot when your portfolio is that small. So a key back then, at least when my portfolio was small and there were commissions, I'd have to only have like 2 or 3 different positions, because if I had more than that, I would be spread too thinly and the commission would just eat up all my potential profits. So now, naturally, as my portfolio started to grow, something like $100,000, using Wealthsimple that doesn't charge any commissions, I started to wonder, how many positions should I have? I'll also leave a link in the description below for my Wealthsimple referral. If you're still paying commissions on any trades, you shouldn't. You should be using this app. It's the only one in Canada, I believe, that has no commissions. My personal investing strategy was to buy a lot of VFV, and then I'd have a few other stocks, maybe 10 or so, that I'd track against VFV to see how I would do against the baseline. And those 10 stocks slowly grew over time. Now I have about 20 different positions. What I found as just one person was that it was hard to stay on top of 20 different companies. It was just too much of a cognitive load to handle. It also meant that each position in your portfolio took up a smaller overall percentage of your portfolio. And while this minimizes risk, it also minimizes your gains. So even if your stock doubles or triples, it really budgets your portfolio a small amount. So if you are about minimizing risk, it really makes more sense to just buy an index fund like VFV. So if you are picking stocks, these should be very high conviction plays, and you should be spending a lot of time researching them and are willing to hold them whether they blossom or whether they sink. So right now I have about 20 positions still. Some are quite small. I'm trying to get my portfolio to around 10 positions. I feel like that's the sweet spot to being able to know what's in your portfolio, but then picking one bad stock still doesn't sink your portfolio. For me, seeing positions that were over 100K were really just pretty shocking. I thought that would be too much risk. What if this stock sinks? But as your portfolio grows, this is just something that you'll have to have. So my biggest piece of advice for those of you who have made it to the end of this video is to hold on to stocks longer. I've had stocks go right down to zero, but seeing that doesn't hurt nearly as much as watching a stock that you sold go up 100 times. First, a disclaimer, it really depends on picking companies that can continue to grow over time. But back in maybe 2014 or 2015, I was buying and selling shares of AMD at around the $4 or $5 mark. My philosophy at the time was to make about $100 a day and I'd be good. Needless to say, I wasn't waiting for huge gains. Anything like a 30% gain, I would most likely sell. Even my very high conviction plays, as soon as they saw something like a double up, I would sell at that point. So at this point in time, I probably sold my AMD shares for about 100% gain, which at the time I thought it was quite a lot. It was like $5,000. Since then, AMD has gone up 50 times and will likely go up 100 times since what I bought it at. I know what you're gonna say, that hindsight is 20/20 and there's no way I could have known that AMD was gonna do this. But my point is, the stocks you should be buying, you should be convinced have the potential to go up 100 times, barring any substantial changes to the company. I'll explain the math behind this here. The very worst case scenario, my $5,000 goes to zero. Now let's say I wait and the stock goes up 10 times, maybe in 5 or 6 years. That's something I've done. Then you've made about $50,000. which is a good amount, but not life-altering and may take maybe 5 or 10 years to get there. Now comes the dream scenario where the stock goes up 100 times and your 5K investment turns to $500,000. The majority of the gains will come in that final double up when your value goes from $250,000 all the way up to $500,000, which is a lot. And on that initial investment, it goes from being 50 times to 100 times. The compounding growth is very key, and I believe the greedy nature of humans prevents a lot of investors from ever realizing a 100 times gain. So those are the goals of my portfolio, narrowed down to about 10 high conviction plays that I believe have the potential to go up 100 times. The main caveat with this is you can't pick very large companies such as Apple or Nvidia, because there's simply not enough capital in the world for these companies to 100 times in a reasonable time frame. Let me know your thoughts on my diversification strategy in the comments below, or let me know what your diversification strategies are. That's it for this video, guys. Hope you enjoyed it. Don't forget to leave a like and subscribe if you have not already. Enjoy the rest of your day and see you in the next video.